The sun rose on January 21st, 2026, and it was supposed to bring a new financial world. I told you January 20th would change everything. The executive mandate was clear, a 10% cap on all credit card interest rates. But for millions of you, you woke up this morning, opened your credit card app, and it still said 24.99%. It still said 29.99%. For some of you, it even said 32%. Nothing had changed. The promise hit a brick wall. Why? Because right now, behind the scenes, a secret standoff is happening between the big banks and government regulators. I am the financial coin historian, and today we're uncovering exactly why this 10% cap is being blocked and, more importantly, the specific move you need to make right now to force their hand. For weeks, the American public was told that this was the day the crushing weight of high-interest credit card debt would finally be lifted. This morning, millions of you logged into your banking apps. You checked your Capital One dashboard. You looked at your Chase statement, you opened your Synchrony portal. And what did you see? You saw 24.99%. You saw 29.99%. The digital numbers on the screen stared back, defying the executive order, defying the political promises, and defying the hopes of the American people. The media is calling it a glitch. The banks are calling it a systemic integration delay. But we are financial historians. We know that in the world of money, there are no glitches. There are only moves and countermoves. What you're witnessing is not a technical error. It is a secret standoff. It is a calculated high-stakes rebellion by the financial sector against the federal government. Today, we're going to expose the reality of what happened on January 21st. We will prove to you that the technology to lower your rates already exists and was used perfectly just yesterday for Wall Street's own benefit. We will take you inside the legal gray zone of the One Big Beautiful Bill Act that the banks are exploiting. And most importantly, we will give you the Work-Affirm Force Compliance Protocol and the specific script you need to use to bypass the customer service firewall and demand the rate you were promised. The standoff has begun. Let's look at the battlefield. First, let's completely dismantle their excuse. If you call your bank today, the customer service representative who is reading from a script prepared by the Bank Policy Institute will tell you that updating interest rate tables for millions of customers is a monumental technical task that requires months of testing. They're calling it a systemic integration delay. They claim that rushing this change would crash the banking software, cause billing errors, and create chaos. This sounds reasonable to the average person. Technical changes take time, right? Banks deal with millions of accounts. Safety first. But it's a lie, and we have the proof. On the exact same day this cap was supposed to go live, January 20th, 2026, another massive financial transition took place. Walmart Inc., the world's largest retailer, moved its entire stock listing from the New York Stock Exchange to the NASDAQ. Its ticker symbol, WMT, officially joined the NASDAQ 100 index. Now, this wasn't just changing a ticker symbol. This required the real-time synchronization of hundreds of billions of dollars in market capitalization. It required updating the NASDAQ 100 index and multiple other sector indices. It involved recoding the algorithms of thousands of passive ETFs and pension funds that track these indices. Every fund that holds the QQQ had to automatically sell AstraZeneca and buy Walmart, billions of dollars moving in milliseconds. And guess what? It happened seamlessly. At 9:30 a.m. yesterday, Walmart began trading on the NASDAQ without a single glitch. The stock even gained 4.7% in the sessions leading up to it. Perfect execution. So let me ask you this. If the financial system can migrate the world's biggest retailer across exchanges and rebalance trillions of dollars in investment funds in a single morning, why can't they change a 29 to a 10 on your credit card profile? The answer is devastatingly simple. The Walmart transition made them money. The credit card cap costs them money. The technical delay is not a technical issue. It's a policy choice. By keeping your rate at 29% for even one extra week, the banking industry generates billions of dollars in additional revenue. They are betting that the administration will blink before they do. They are daring regulators to enforce the mandate. This is not about software. It is about a revenue strike. The banks are holding the line because every day they delay is another day of profit under the old system. To understand why the banks feel so safe defying the president, we have to look at the law itself. And this is where it gets interesting. The One Big Beautiful Bill Act, or OBBBA, is the centerpiece of the administration's economic policy. Signed into law on July 4th, 2025, it's a massive, sprawling piece of legislation. But here's the secret the banks know, and they're counting on you not knowing it. The OBBBA is primarily a tax bill, not a banking regulation bill. We've analyzed the text, hundreds of pages. The act permanently extends the tax cuts from 2017. It makes the Section 199A deduction for small businesses permanent. It resets the alternative minimum tax thresholds. It creates huge incentives for qualified small business stock. It includes the SALT cap increase and senior deductions. All of that is in there, codified, permanent. But nowhere, I repeat, nowhere, in the final text of the OBBBA is there an explicit codified mandate for a 10% interest rate cap on private credit cards. The 10% cap comes from a mix of executive orders, presidential statements, and the proposed Sanders-Hawley Credit Card Interest Rate Cap Act, which is currently stuck in a Senate committee with no clear path to passage. The banks argue that an executive tweet or a press release does not override a private credit contract. And legally, they might be right. They are standing on the principle of contract sanctity. When you signed your cardholder agreement, you agreed to a variable rate based on the prime rate plus a margin. Unless Congress passes specific legislation explicitly overriding that contract, the banks believe they are on solid legal ground to ignore the president's demand. This is the implementation gap. There is a disconnect between what was promised on the campaign trail and what was actually written into law. The administration is trying to use the Office of Big Bank Behavior and Accountability, a new regulatory arm created by the OBBBA, to enforce the cap through pressure, not law. They are threatening audits. They are threatening to remove federal deposit insurance eligibility. They're threatening to exclude non-compliant banks from Federal Reserve facilities. But the banks have calculated the risk. Their legal teams have run the numbers. They believe they can drag this out in court for years while continuing to charge you 30%. This is a game of chicken between the executive branch and Wall Street. And right now, as of January 21st, Wall Street is holding the line. We have been here before. As historians, we know that banks resisting federal mandates is a tradition as old as the Federal Reserve itself. Let's go back to 1915. The par collection conflict. This is a story every banker knows, but they hope you don't. When the Federal Reserve was created in 1913, it wanted to create a modern, efficient system where checks cleared at par, meaning face value without fees. Before this, small country banks made a fortune by charging exchange fees every time they processed a check from a distant bank. It was a junk fee, pure and simple. If you wrote a check for $100, the receiving bank might only credit $97, keeping $3 as an exchange fee. Multiply that across millions of transactions, and you see how profitable this was. When the Fed mandated par collection, checks must be honored at face value, the banks revolted. They didn't just complain to Congress. They didn't just file lawsuits. They fought dirty. Some banks began stamping their checks with the phrase, "not valid if presented through Federal Reserve." They actively sabotaged the central bank's payment rails to protect their fee revenue. They were literally trying to break the Federal Reserve System to maintain their profit margins. It took years of litigation, Supreme Court cases, and immense political pressure to break their resistance. The Fed eventually won, but not before banks delayed implementation for as long as they possibly could. Today, the 29% APR is the new exchange fee. It is the revenue stream the banks refuse to give up. And just like in 1915, they are using technical difficulties and legal challenges to stall. The systemic integration delay of 2026 is the exact same tactic as the stamped checks of 1915. It is an institutional refusal to surrender profit for the public good. Understanding this history is vital because it tells us how this ends. It ends when the federal government uses its ultimate leverage. In 1915, the Fed eventually forced compliance by threatening to cut banks off from the central clearinghouse. No access to the payment system meant economic death. Today, the administration may have to threaten to cut banks off from the Fedwire system, the discount window, or Federal Reserve liquidity facilities to force them to accept the 10% cap. But until that nuclear option is used, the standoff continues, and you are the one paying the price. The banks are not just using lawyers and delay tactics. They are using fear, and their weapon is a threat they call the credit desert. Groups like America's credit unions, the American Bankers Association, and the Bank Policy Institute have issued dire warnings. Their argument is cold, mathematical logic, and it's designed to scare policymakers into backing down. They say that lending to subprime borrowers, people with FICO scores below 660, carries a high risk of default. Historically, banks have covered the losses from people who don't pay by charging high interest to everyone else in that risk category. It's called risk-based pricing. If the government caps interest at 10%, the banks claim they can no longer mathematically price that risk. The numbers don't work. So what is their threat? If forced to cap rates at 10%, they will simply cancel the credit card accounts of 47 million Americans. If your credit score is below 700, you are in the crosshairs. If you're below 1660, you're almost certainly targeted for account closure. Bill Ackman, the billionaire hedge fund manager, tweeted and then deleted a warning that this policy would force banks to decimate credit availability. The banks are effectively holding the economy hostage. They are saying, let us charge 30%, or we will cut off credit to the working class entirely. They warn that this will drive millions of people toward payday lenders, auto title loan shops, and actual loan sharks, where the effective rates are 400%, not 30%. This is a powerful weapon. No administration wants to be responsible for 50 million people losing their credit cards overnight. It creates a political paradox. The policy meant to help the poor might end up cutting them off from the financial system entirely. This threat is why the standoff on January 21st is so tense, yet so silent. The administration is afraid to push too hard, lest the banks pull the trigger and initiate a mass cancellation event that would crater consumer spending and trigger a recession. So what can you do while the giants fight? Well, you cannot wait for the Supreme Court. You cannot wait for the Senate. You need to act now. Consumer advocacy groups and financial analysts have developed a strategy called the Force Compliance Protocol. It is based on the fact that while banks are publicly resisting, they are privately terrified of being singled out by regulators. Regulators are compiling a master list of holdout banks. No bank wants to be at the top of that list. They don't want to be the example that gets hammered with enforcement actions. If you call customer service and just ask for a lower rate, the first level agent will say no, they have to. Their system doesn't even give them the option to change your rate. You need to bypass them. Here is the exact script you must use. Write this down. Record this. This is critical. Step 1. Call the number on the back of your credit card. Do not ask for customer service. Do not explain your issue to the automated system. When you get the menu, immediately say or press the option for retention department or account specialist, or ask directly for a regulatory compliance liaison. These are the people who have actual authority to override the system. They are the ones with discretion. Step 2. Once you are connected to a specialist, do not complain. Do not argue. Use this exact phrase. I'm calling regarding the January 20th OBBBA interest rate parity initiative. My account has not reflected the 10% cap as of January 21st. I'm formally requesting a review of my APR under the new 2026 federal guidelines and OBBBA compliance standards. Why does this specific wording work? Because you are using trigger words that create a compliance record. OBBBA, interest rate parity, formal review, federal guidelines, and compliance signal that you are not just a complaining customer. You are an informed consumer creating a documented request. Banks are required by law to log these specific compliance-related requests. If they deny you, they create a paper trail that could be used against them in future regulatory audits or enforcement actions. To avoid that risk, many retention specialists are being quietly authorized, off the record, to manually lower rates for vocal, informed customers who use the right language. They won't do it for everyone. The bank can't afford to. But they might do it for you if you create enough compliance pressure with your wording. Step 3. If they say no, ask for the denial in writing. Say, I would like documentation of this denial for my records, including the specific regulatory basis for maintaining a rate above the stated federal guideline. Most banks do not want to put denials in writing during a regulatory gray zone. The act of requesting written documentation often causes them to reconsider. This is financial guerrilla warfare. You're exploiting the bank's fear of future regulation to get the rate they refuse to give you voluntarily. It won't work for everyone, but it's working for some, and that's more than nothing. We are currently compiling real-time data from viewers like you. We are building what we're calling the master list of holdout banks. Right now, the reports are flooding in through comments, emails, and social media, and the picture is becoming clear. Chase. Multiple reports of no changes. Rates still at peak levels. Customer service deflecting with technical delay scripts. Bank of America. No changes reported. Some customers report being told rates will be reviewed in Q2 2026, which is a 3-month delay. Citi. No changes. Aggressive pushback when customers mention the 10% cap. Synchrony, the issuer behind many store-branded cards like Amazon, Walmart, and Target cards, is perhaps the most vulnerable. They rely entirely on credit card interest for revenue. Multiple reports indicate they are locking down customer service lines, routing compliance-related calls to voicemail systems, and implementing callback delays of 24-48 hours to prevent immediate pressure. But we are also hearing whispers of cracks in the dam. Some smaller credit unions and regional banks, institutions that are more sensitive to local public opinion and regulatory pressure, are beginning to issue what they're calling provisional credits, or promotional rates. They're not officially changing the terms, but they're effectively lowering the rate to 10% through temporary promotional adjustments that they're quietly making permanent on a case-by-case basis. This is how the dam breaks in financial history. Not all at once in a dramatic collapse, but from the edges inward. The small institutions break first because they can't afford the PR nightmare. Then the mid-sized regionals follow. And finally, the big national banks are forced to comply because they're the last ones standing. The secret standoff of January 21st is the defining economic confrontation of 2026. It is a test of who actually runs America, the elected government or the financial institutions that control the flow of credit. If the banks win, the OBBBA is exposed as toothless and the debt trap continues indefinitely. If the federal mandate wins, we enter a new era where credit is cheap but scarce, where rates are capped but access is restricted. You're not just a spectator in this fight, you are a participant. Let's circle back to Walmart one more time, because the contrast is too important to ignore. While the banks are pleading incompetence and claiming they need months to update a simple interest rate field, the real economy moved forward flawlessly. Walmart's move to the NASDAQ 100 on January 20th required removing AstraZeneca from multiple indices, rebalancing thousands of ETFs globally, processing billions of dollars in automated trades, updating every financial terminal on the planet. All of this happened in milliseconds at 9:30 a.m. Perfect execution. Meanwhile, banks claim they can't change $29.99 to $10 in their database. This is the split-screen economy we're living in. On one side, you have the efficient, high-speed world of equity markets where complex maneuvers happen flawlessly. On the other side, you have the consumer credit market where banks act like it's 1980, claiming that changing a number in a database is an insurmountable technical challenge. This contrast is what fuels public anger. It's why Senators Sanders and Hawley are calling current credit card rates extortion and legalized loan sharking. The banks are not technologically backward. They are morally resistant. They are choosing to maintain a system of extraction because it generates billions in profit. And they will only stop when the cost of resistance becomes higher than the cost of compliance. January 21st was supposed to be a day of relief. Instead, it is a day of resistance. The banks have drawn their line in the sand. They are betting that you will get tired, that you will get distracted, that you will accept the technical delay excuse and move on with your life. Do not accept it. The technology works. We proved it with Walmart. The law is ambiguous, but the intent is clear. The standoff will not last forever. One side will break. Either the administration will cave and allow the rates to stay high, negotiating some face-saving compromise, or they will unleash the full force of the regulatory state to crush the resistance. Until then, you must be your own advocate. Use the script. Call the retention department. Ask for the regulatory compliance liaison. Document your calls. Save your statements. And comment below with your bank's name and what they told you. We are building the master list. We are documenting this standoff for the historical record. Because in this new economy, nobody gives you financial freedom. You have to take it. You have to demand it. You have to create so much compliance pressure that it becomes easier for them to give you the rate than to keep fighting. The January 21st secret standoff is not over. It's just beginning. This is the first day of what could be a weeks-long or months-long battle. But history shows us that when the people refuse to accept the old system, when they demand change loudly enough and persistently enough, eventually the system breaks. This is the Financial Coin Historian. The ledger is open. The standoff is live. Check your statements. Make the calls. Document everything. And I'll see you in the comments with updates as this situation develops.